I'm delighted to welcome you all to this drinks do, and also as part of City Week. The Investment Association is the trade association that represents the second largest asset management footprint in the world. And as you may have heard in the previous session I mentioned, our members manage from the UK £5.5 trillion sterling on behalf of other clients. It's sort of 2.5 times the world hedge fund industry in size, and about 37% of Europe's assets, which is fairly topical at the moment. And the British government are huge supporters of us. I know this is a global, international event. Just to briefly mention what we're doing in the UK, the British government for years have been supporting, the last 5 years particularly supporting, promoting the industry, promoting asset management around. I think UKTI are here as well, supporting us. And if you want to hear what we're doing and the fact that the UK is open for business, then please come along and chat to us. I was wondering, given the financial crisis and given the sheer cost that has been suffered by people, the Office of Government Accountability in the US assesses that to date the losses suffered in the US alone exceed $22 trillion from the financial crisis, about $13 trillion from damage to the economy, and about $9 trillion for the loss of wealth of individuals. And I wondered, in light of that crisis, whether anything as good has come from it. And so my personal view, doesn't matter whether it's the IA or not, my personal view is that one thing particularly did come from the financial crisis that's a good and hopefully will be a long-term good for us all, and that is the widening from the G8 to the G20 of the group of countries that gather together to have a concern for our economy and the direction of it. Now, I know there are strengths and weaknesses to some of the things about the G20. I know that if you are the 21st country, you're not going to really be reassured there's now a G20. And I know that there are clearly comments about the extent to which Africa is represented at the table. But as an extension from the G8, as a widening out of the countries who are involved, I think it's absolutely right that financial services is part of the global dialogue alongside things like climate change and security. And we're very interested in that because that also shows it's at the heart of our economies and our societies. And we think that asset management at its best is at the heart of our economies and our societies. And one of the things we've done in the UK is to launch probably about a month ago now, a productivity action plan to show the commitment of our industry towards assisting, in this case, British businesses with improving their productivity. Because investment and financial services is about financial services. It's not just about finance. If we are to be anything, we're to be connected to people's aspirations, the desire of people to have education, to live in countries with modern infrastructure, to have access to the things they want to have access to, and hopefully as well to have access to better provision in late life. These are the roles of financial services when it works at its best. I'd ask you to listen to Andrew for a few minutes on what we've been doing. Our hope is not only that you hear some of the things we've been thinking about, that as financial service industry members we will improve productivity in the UK, but how some of those ideas might be ideas that others will pick up. And certainly we have a real interest in socialising this across the EU as part of the Capital Market Union that we're committed to help our economies. So without more ado, Andrew Ninian, one of my colleague directors.
Thank you very much. And I'm conscious that I'm the only thing between you and you probably enjoying your drink, so I will be as quick as I can and productive as I can. But as Guy has outlined, building an economy that is capable of competing internationally, delivering growth in jobs, wages and standards of living is not just a responsibility of governments. As investors, we all have a responsibility for ensuring the success of the economies in which we operate. Fostering a better economic performance is clearly amongst our social duties. But we also have a direct interest in fostering strong economies. If we can play our part in building better performing businesses, then we can improve our clients' prosperity through better investment returns. But it's one area of one economic measure that the Investment Association believes investor can have a remarkable impact and influence on the way that we improve, particularly in the UK economy, and that is productivity. There are stark differences in the level of productivity across Europe, and the fact that by the latest data from 2014, the UK lags all other nations in the G7 group of major advanced economies except Japan. If the GDP per hour worked in the UK as a set an index of 100, productivity in Germany would be 136, in France it would be 131, and the US it would be 130. Shows the scale of the problem in the UK. So with that in mind, our investors, the government first of all launched a productivity plan, and our members as significant investors in the UK decided that they had a role in improving productivity in the UK and wrote to the Chancellor and said that they would deliver this productivity action plan to show that how they could improve productivity in the UK and support long-term investment. Our members were very clear that the way of improving productivity was support more long-term investment for both our economy and end clients. So we developed this plan over 6 to 8 months, and it's an action plan which sets out 12 recommendations how we can support improved productivity in the UK. I'll just touch very briefly on the 5 main areas to give you an overview of the kind of work that we will be taking forward in the next 12 to 18 months. The first is around company reporting. If we enhance a better longer-term reporting from the companies in which we invest, then we as investors will be able to make better long-term investment decisions. So if we can move companies from reporting on a quarterly basis to getting longer-term reporting based on the drivers of productivity and how they're going to allocate their capital in future, we can support companies over the long term. The reciprocal of that is that as investors, we need to up our game as well. We need to be responsible stewards of the asset. So we need to be engaging with the companies in which we invest on these issues around long-term value creation and productivity. There are also issues around the investment chain, so how money flows from the end client right through to the company. And we particularly focus on the relationship between asset owners and asset managers and ensuring those mandates, those long-term relationships are actually long-term and not driven by short-term performance or short-term churn due to performance measurement or other issues. Fourthly, we're looking at how the capital markets operate so that companies have the most efficient access to capital markets, either through the IPO or secondary capital raising process, or alternatively through the different asset classes which investors can invest through. And finally, we'll be looking at how the regulatory and legal system works so that it doesn't inadvertently lead to short-term aspects, such as the debt bias, which means that companies are financing through debt rather than equity, or some of the solvency and risk regulation, which is inadvertently meaning that some of our members are having, as they feel, to be investing in shorter term assets than longer term assets such as infrastructure that they wish to. It's a challenge for all of us, and we're looking forward to developing this over the next 12 to 18 months, and we hope that other bodies and associations can learn from our work as well, and we can, as Guy has already spread this message across the EU. But I will hold you no further from your drinks, and we wish you a very pleasant and enjoyable evening, and enjoy the rest of your conference. Thank you very much.